Stocks had a little bit of a breather today after a strong run these past few days. So I'm going to break down, what this looks like in terms of, retesting the low points that's been talked about for so long that now is not getting talked about nearly as much anymore from a more mainstream standpoint. So we're going to talk about what that means and how that impacts our expectations, what a retest of the lows might look like if we do get one. We're also going to talk about this idea. We've talked in the past of pricing in, 4 weeks, 35% drop, prices in a lot of bad news. We're going to look at the other direction, that the idea that we postponed a lot of selling until this 4 week period, that we kept going up and up and up. And we're going to talk about why and what intermarket relationships show us that we were a lot more bullish than we should have been. We've talked about it before from a sector rotation standpoint about these mega cap stocks keeping us up and not being in a bear market like some of these international markets have been in. But there's some other things that kind of show us that instead of pricing forward some bad news, we've actually postponed the selling to a short period of time where it all occurred in a matter of 4 weeks instead of over a longer period of time since when this bear market actually started. So I'm going to break that down in today's video, as well as a trade idea for a stock that if we do continue to trend higher and we do continue to V-bottom to the upside, one stock that's been leading the market, that's been outperforming the market, that can lead in that type of environment as well. So let's go ahead and get started. Today is Monday, April the 13th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the intermediate line is crossed up above 50. So what you do now is you have a dark green shading. And again, you can have dark green shadings here. And let me go back a few years to some of these bearish periods, and you can see brief dark green shadings. There's a dark green shading right there. During that run, there was some dark green shadings for a little bit longer during this bearish run. And then you can see going back all the way, of course, to 2008, 2009. Here, give me 1 second here. I don't know why I always have to do this. Price access will fit the studies use log scale. There we go. So let's go back out to 2009. See, this is 2011. Here's August 2011, brief period of dark green shading before we finally turn the corner there in September, October of 2011. Dark green shading right there briefly in 2010, coming off of that during that bearish period. And of course, 2008, 2009, we got a long period of dark green shading here before coming down and coming into this bearish period. Of course, you got that period of dark green shading during the initial bearish run. And a brief period of dark green shading during that bearish run. The nice thing is the dark green shading usually means we're closer to the end of the bearish run than we're not. So it might not mean that we've completely reversed to the upside, but at least it means we're probably getting close to the end of this dark pink shading and red line. Right, again, so we'd have to turn over pretty quickly to keep that moving average rolling over, and it hasn't turned up yet. Otherwise, it turned green. But there's a lot of stocks where it has turned up and turned green. So just keep an eye on that down day that we had here. One of the few. We've only had a few down days. 1, 2, 3. See, 1, 2, 3, 4, 5, 6 down days since we bottomed out. So it's been a pretty decent bullish run. In fact, the market sentiment line's rising now. It never did drop, dipped its toe a little bit below 30, never did drop below 20. You can see, though, the near-term line, as it did over here, has pulled back down below 20. Now, we are coming down from a higher near-term high point. And so you would expect, because of that, we'd come down to a higher near-term low point. So that's something to keep an eye on. The momentum line also didn't drop. Now, that's the S&P, and pretty much everything else looks exactly the same. The Dow Jones Industrial Average, the NASDAQ Composite, all look almost exactly the same. The Russell does not. The Russell actually had a stronger near-term run because it had a lot of room to go to climb up to a higher near-term high and to get that light pink shading and yellow line pattern. But unlike the S&P, where it's kind of easily gotten up above this, the Russell didn't. And the Russell is not up to, if I were to activate this to this level here, where we dropped 50%. See, it's only up to the 38% level, whereas the S&P and all these other big tech name dominated indexes, they all got to the 50%. The Russell only got to the 38. It's got this bearish pattern here, and its momentum line has dropped down into oversold territory, and its near-term line dropping back down. Near-term line dropping back down on all these others too. So, again, it's we could look a lot worse than we do, but also keep in mind that we're not out of the woods yet either. We're not on a bullish trend by far. We will get near-term pullbacks where the near-term line drops down, and the more frequent. Eventually, when you get a near-term run, or excuse me, an intermediate rally that starts up above 50, like the S&P has, when we get a good, strong near-term rally, that first near-term run typically is pretty long. When you can see even here, you had a really good near-term rally that brought your near-term line up above 50, and then kept it going for a while. You can see one over here. Brief little dip there, but then you had a pretty decent near-term rally more on the Russell 2000 during this period of time. But over here, you can see if we don't get a strong near-term run, as you saw in some of these others where you had dark green shading, if we don't get a strong near-term run to keep us up above, keep that intermediate line up above 50, then we turn right back around. And that's where we have the brief dark green shadings that roll right back into dark pink. You can even see it here. That was actually a pretty decent near-term run that got the intermediate line up above 50, but then it was done. Just like that, it was done. And here we finally got above 50. If we're done, if this near-term line drops tomorrow back below 50 or even lower, then that's not a good sign for the potential of this dark green shading to last and actually turn into a good intermediate run. Where we start off for a while. So something to keep an eye on. Just remember, we don't have the dark green shading. We have the bearish pattern of light green and yellow line on the Russell 2000. So we are definitely not out of the woods yet in terms of here we go, back up the bullish truck, and let's load up here. As always, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Also, hit the thumbs up icon that's down there. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. If you don't want us to do these videos tomorrow, it's a quick way to let us know. And you don't have to click anything down there. Also, while you're down there, comment on anything you got out of today's video. Love to see what you picked up, what you thought was interesting, what you got out of it. Join our website at marketscholars.com. There's a link popping out in the top right corner of your screen. Click on that link. It opens up a page where you can subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website here on our video, we invite you to check out some of these other things here on the sides, including our upcoming classes, our Market Outlook live video where we review past Market Outlook trade ideas, continue to manage them until the time we close those trades. In these videos, you get the entries, but you don't get the exits. The exits come in these live trade review videos. All of our classes are included with our monthly subscription plan. There's some more information on that. If you click on the word pricing, you can see the differences between the Premium Plus individual plans there. Down here at the bottom, we invite you to engage with us here on social media. Click on that heart. It opens up a new window. You can like today's Market Outlook tweet. Click the thumbs up. Like today's Market Outlook Facebook post. Again, the more you engage with us on those platforms, the more those platforms will promote our content to you. So we try to make it really easy for you to engage with us here by just clicking on these icons. All right, let's get back to the charts now, and let's take a look at the long term, the weekly chart, and how we started off the week here. I remember this is a weekly chart, so it still has multiple weeks left to go. And you can see now it's going to get harder. We've had the little breakout. We broke out the last 2 weeks. It's a good close there. But you can see now why we're struggling to get going above last week's highs, because there's that 50-day moving average and this long-term trend line that you can't really see here. I have to go out a little bit further. Let me go out to 20 years, and you can see this long-term trend line coming up above these highs. Well, we're hitting up against that on the downside right now. So that's kind of why we had a little small range. It's a very small range here, right at the 50, sitting right at that trend line. So we'll see how we end up finishing up this week, but you can see how bullish last week's was. In fact, we've had 2 really good weeks in the past 3, and that's led us to a really strong Hakenyashi close, again closing above these 2 highs. Still a long upper shadow, and you can see when you close above these highs, it might take a week or 2 to close, to get higher highs. But as long you don't have to close above the highs anymore, as long as you're just getting progressively higher highs here on this upward trend. You can see we closed above all these highs right here, good bullish breakout close, and then we had another good bullish close, but it was mainly just getting the higher highs that kept this trend going. It's kind of hard to close above each new high point. If we do, great. If we don't, then it's hard to maintain the bullish trend. And so again, it's going to be hard to close above last week's high. Not impossible. And if we do, great. If we don't, as long as we get a higher high, that's a good step. And that would obviously mean that we're getting up above this 50-day moving average as well. From a 3 green arrow standpoint, you can see the MACD is rolling over here on the 817 MACD, showing us some loss of momentum, but still pretty strong positive momentum there. It was our lowest volume day, well below the average, and the average is rolling over. 3 green arrows, of course. And if you look at the 2-line versions of these 3 green arrows, remember we talked about the stages of reversal here, getting above the 8, getting above the 17. Well, you can see now the 8 and the 17 getting above the 30 would be a really good stage, and we're not quite there yet. The moving average itself isn't above 0. Our MACD histogram, as I mentioned, is rolling over. The MACD is above 0, great, but we're starting to lose some of that positive momentum. We're still above the 8-day moving average too, so that's a good sign, but they're all 3 right there. So if we were to close too far down, we'd really easily get below all 3 of them. So that's something to keep an eye on as well. If you take a look at the intraday chart here, let's take a look at that. Where is it? Right here. If you take a look at the intraday chart, you can see that gap right there is still out there. I mean, that's still a gap to fill, even though we're well up above. Now, it's not going to be easy to get down there. Getting down to 260, there's going to be some pretty strong support at 260. And then you have, if we fill that in, it's not like it's a guarantee to bust down either. I mean, that basically would get us down to 250, where the midpoint of the 4-week range is now, and that will be the midpoint, depending upon whether we produce new highs. That will be the midpoint for another week or so, because you can see the low's not going to move up. There's been some talk about whether or not we'll retest those lows, and the Fed and their actions keeping us. And remember, this runaway gap here, I mean, again, if we come down to this level, filling in that gap, that might be where the extent of our selling. Obviously, if you break through there, then your next support level is right at the bottom of this value area, the 4 weeks, where most of the volume is. Of course, that's going to change as day by day goes by. But then after that, you can see there's very little volume below us. So it's, if we fill in that gap, it's going to be really easy to keep going down towards 210, where there's a real strong support level on the 5-year volume chart. But until then, there's going to be some pretty strong support ahead of that. 245, 250 to 245, 240 to 235 at the top of this gap in that area here. And then we go down. So again, you expect support to hold until it doesn't. So when we talk about retesting the lows, coming down to 250 might be all the lows that we retest. There'll be some support at 260 here, but filling in the rest of that gap, that might be it. That might be the retest of the lows. Of course, we can, if we break through that level, then you can see where the next level of where quote-unquote retesting the lows will be to. And again, just getting to 250 to 25 is almost a 10% drop from here. So it's not like that's just a little small pullback, right? That's a pretty decent decline. Not as big of a decline as we saw when we fell 30% in 4 weeks, but it's also not just a 1 or 2% pullback either. If you take a look, in fact, the nice thing is, and we talked about before, we're not going to fall nearly as fast on the retest as we are here, and you can see as big as the drops and the rallies were, the rallies are starting to get smaller, and the drops are smaller. So again, if we come down to these levels, 2450 on the SPX, 2500 at the top of that gap, bottom of that gap there, that's going to be, we're going to come down a lot slower. You can see the historical volatility is already dropping significantly. So don't be surprised if we don't make one jump in volatility back towards, not at 80%, because that would mean we'd have to jump there tomorrow. But as this continues to fall, don't be surprised if we don't pop up on the VIX one more time to get up above there, and have that one more jump up above historical volatility like we've seen in the past, before historical pops back up. We get some bigger moves toward in these low areas, and then we form the low point, right? As I've mentioned before, the low point, today's volume was so very light. And it's a good sign. Volume's dropping. The trading range was also very small, 6 points. That's barely more than 2%. So that's a good sign. That's bringing this line down. But remember, usually the low point doesn't form until we get down to these levels. So as we pull back, don't be surprised if we don't get some bigger move. Now, again, a 3% move on 275, we're talking about, almost 8-point ranges. So there's going to be some relatively bigger ranges if we were to kind of exhale here a little bit. But as long as we're not looking at like 14-point days or 12-point days like we were over here, then we're not going to be looking at any kind of like Great Depression 1929 type scenario, more like the 1987 type scenario that we've talked about before. All right, let's take one last look at the Volatility Index. As I mentioned before, one last push is probably out there on the VIX. You can see it's not breaking below this 1% mark. It's barely flirting with the 105% mark. So there's some opportunity. In fact, we open up at the 100% mark. This is going to be a support level. It was a support level over here for the VIX. This is going to be a support level as well. And even if we break it down to 95, that's going to act as a support level on the VIX in the short term for it to pop up from these low 40 levels that we're at right now. So some more down days. That's what the volatility index typically does. But again, the low point doesn't form until we break below, at least break into this neutral range. And you notice we're not even close to that. So as much as volatility has been dropping, it's interesting. It's still high. Volatility is dropping. Here, if I go to the VIX 3 months here, you can see it's dropping too in that back month, just as much. So even though the VIX is low, right? Even though the VIX is low compared to where we were, it's still pretty high relative to this, still above 100%, which means there's still some volatility expectation in the short term. And the fact that it is at a low point, there's still an opportunity that we can bounce back up. So, again, back towards that historical volatility, which is starting to make its way down again. So we're not out of the woods yet here either on volatility. Don't be surprised if we don't get at least one more hurrah. And again, when we've seen in the past for volatility, when it makes these big spikes up, it doesn't usually just go up and come right back down. It usually makes one little, some last little hurrahs here up and down, albeit at much lower levels, but you get the idea. We can go up and down here. And of course, there's your 2008, 2009. We came down to these levels, and we had one last hurrah at the beginning of 2009 where we jumped back up again off of that 95% mark. First off of the 100 and 105% mark in November, then off the 95% mark in the early part of 2009. All right, so to summarize, before we finish up and talk about what's driving the price action and talk about our trade idea of the day, to summarize the technical outlook, we have a really, really good bullish outlook. We've had a strong run to get to these levels, a lot stronger on the S&P and the Dow and the NASDAQ because of these big, large cap names that has helped push us up. And again, we've talked about utilities and real estate, and the hardest hit names are the ones that have been rallying the most. Now we'll start to pull back, and the question now is who's going to lead us on the pullback, if and when we get this pullback, and what this pullback looks like. One last push higher in volatility. What we want to see, even during the pullback, is we want to see the cyclical names lead us during that pullback. We saw that in 08 and 09, where the hardest hit names, the interest rate sensitive areas, led during the bounce and the pullback initially, and that's what led us to another low point. And then from that low to that successive low point during the next pullback, your cyclical areas held up much better on the next go around. We saw that a little bit today, as you'll see here in a minute. That's a good sign. That doesn't mean that we won't pull back, but it does mean that if those continue to lead during any period of weakness on equities here, no matter how far down we go, and I gave you some ideas of how far down we could go before we reach some support levels. As long as these cyclical areas are leading us on the way down, that will be a very good sign that the next low is a lot more likely to be the low point that we form. So what do you think? Do you agree with that assessment? You disagree? There's a link popping out right there on the top right corner of your screen. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing differently than what we're coming up with here on our charts during our routine here today? So looking at how things have performed today, you can see a little bit of a rollover here, and especially in small cap stocks, which have been doing decently the last couple of days. Again, going back to that March 24th low point, and since then, to kind of gauge the rally that we've had. There's your real estate, there's your preferred stocks. They typically lead early on when these have these humongous sell-offs. They tend to, they've led before, and they're leading this go around. You can see bonds and the dollar's down. You can see crude oils continue to stay lower, and gold's been up because of the weakness in the dollar, but still lagging behind. But we're still seeing some lag behind in international equities despite the weak dollar, which is not necessarily a good sign. And we're also seeing a lag behind in small cap stocks, which also isn't the best sign either. Just going over the last couple of weeks here, just going over a 10-day performance on this chart. You can see the strong move we had out in crude oil really throwing off the scale of this chart, but it's come way down. Still up 16% over a 2-week period, just not down. We had a good strong run over a couple of days of 40% in USO, and that brought up a lot of this risk appetite. Small cap stocks, which were initially in this 2-week period really lagging, they've caught up to the S&P, but your international stocks haven't. And again, with the weakness in the dollar, we want to see the weakness in the dollar. That's going to sustain more of a longer term bullish run. We're starting to get that here. You can see the nice little pullback. It's light pink shading. It's still green line, so we're not quite there yet, but the intermediate line's rolled back over, back below its market sentiment line, which is also falling. So weak, bearish at best. You take a look at its weekly market forecast as it's just starting the week. It's rolling over potentially. So it looks like we're starting to pull back, and that's a very good sign for this low point to be developing. Doesn't mean we're over with, but it's a good sign for bullish risk appetite going forward from here, is to have that dollar dropping. Stocks do better in these environments where the dollar is weaker, when the dollar is in its light pink shading or dark pink shading and red line periods. As you take a look, if I were to go out further, and you can see we don't have very many, but during these periods where we've had weakness in the dollar, and I put on the comparison chart of the S&P 500 during those same time frames, so comparison with the S&P, you can see that during this period of lots of dark pink shading and red lines, the stock market did really well. Then we stopped getting those, and the stock market went really bare. In fact, during that period, that's 08, right? And then, of course, you had another period of dollar strength during the right before QE2, and you can see dark pink and red lines led to some really good bullish markets and equities, and the dark green and green lines have been pretty bearish. And that's the interesting thing, is the dollar's been in that pattern since January of 18, and while we haven't been down in the S&P, we've had a lot of volatility, and a lot of people, and myself included, point to that's the beginning of this global bear market that we've been in, that the S&P is avoided because of these large cap, mega cap names that's helped lift it and keep it higher, even as the intermediate line here on the dollar continued to get lower and lower as the dollar weakness was coming down. We still stayed bullish. Well, that's why we dropped so much, right? We were so far elevated, far more than what we should have been, considering the type of market the dollar was in. Well, we recovered that pretty quickly, and now we're below that January 18th high point. But again, it would be a very good sign for risk appetite if we were to get back to a dark dark pink shading and a red line pattern here on this weekly chart, and we're not quite there yet. We have to get to a light pink and yellow line first, which typically will be a bounce opportunity that we have to keep an eye on. Some of these can be bounce opportunities there, so we'll keep our eyes on that. But then that also leads to a reversal, and that's when stocks can really just take off from there. Let's take a look at the yields, because that's getting some. There's been some chatter on the 10-year yield slowing down. Take a look at the yield here, and you can see the low point appears to be setting in. We did get the light green shading in the yellow line, and we rolled back down and tested to the downside. But now we're getting a lot closer. We're not so far away from that 30-day moving average. The intermediate line's rolling back up from what would be a higher low point, still above its long-term market sentiment line. So again, another sign of risk appetite for the markets is a bullish trend on the 10-year yield. The longer it's in a dark green shading here, let me roll this out to a little bit further period of time and throw on a comparison chart as well. A comparison with the S&P 500. You can see when we have dark green shading, green lines, we can be pretty bullish there too. And then we can be pretty bullish with some falling yields. And you can see there's a good run on yields and a good run on equities. But typically, when you got dark pink shading and red lines, that's a pretty bearish time, as we've seen. Again, that's the period that we've been in this case, since October of 2018, where we got this divergent low point. Right, the initial was January 18, where I feel like the bear market started. We got the divergent low point in commodities as well as yields, because again they lag behind. Inflation lags behind. So we got the divergent low point there in October, and it's been that way ever since. So this is very much an anomaly to be in dark pink shading and red line, but to have such a bullish run in equities. And again, to see how quickly that was resolved. Part of the reason why we were so bearish, why we fell 30%, isn't necessarily, I've been under the idea that we pulled forward a lot of bad news, and we have pulled forward a lot of bad news. But the reality is we pulled forward a lot of buying, we've avoided a lot of the selling over the past, year or so, and we probably should have been, this tells us we should have been down here a lot earlier than we were now. But instead of pulling back, as all these international indexes have, we rallied up to these extreme high points. And so we pulled forward a lot of buying. And that got rectified really quickly. So I think a lot of this 35% drop doesn't have as much to do with what we're expecting going forward or what the market's pricing in. I think it has a lot to do, too, with the fact that we went way too far up compared to what we should have been, according to the long-term trend of the dollar, and then here the long-term trend of yields. Now, we have an opportunity once things turn around to roll back up again. But you notice, even on this long-term chart, we're still not there yet. Like, we're not anywhere close to dark green shading and a green line on these yields. So still expect some choppiness as we work through this part. We can be bullish as we run up to that moving average, but expect some choppiness until we turn it around and we can be on a much more bullish trend, a much more persistent and consistent bullish trend going forward. Finally, one more thing to take a look at is commodity prices. So let's take a look at crude oil. Like some of these other charts, you can see it peaked in October. So, instead of peaking in January here, again, we got divergent high points going into October. It makes sense because it's a lagging commodities, and crude oil especially is lagging. We were bullish during this dark green shading and a green line period. We've been in basically dark pink shading and red line, intermittent with light green shading and yellow lines. We never really got a persistent trend of dark green shading and green line here. And then we fell back again. See how far away we are. This is again on the weekly market forecast. You can see how things can get really bearish pretty quickly. And here we were so bearish, and stocks just were choppy and flat before we had this bullish run that ended there. But ever since we peaked in crude oil, we've been really volatile here. In fact, we're below that October high point, not nearly as far below as we should be, according to what some of these charts are telling us. So again, that's why, we might not be done with, if we were to come back down towards 110 on crude oil, or excuse me, the S&P, if we were to come back down towards 2,500, sorry, over on the left-hand scale, then, again, that would be a lot more in tune compared to that October high point with where commodities themselves are at. If I were to take a look here, again, at how we've done since that October 26th of 2018 peak, where I felt like the bear market started, and let's go to a weekly chart here. This is how the market has performed. So remember, the dollar was really bullish during this period. Commodity prices were bearish during this period. On a long-term charts, were bearish during this period. Yields were really bearish during this period. So not surprising to see utilities and real estate up significantly from that spike, 30-40% returns. Technology, the big FANG names, leading us up higher. Again, we don't have XLC on this chart, so all those big FANG names are here in XLK. So those were that was the one reason. Amazon here in the XLY also keeping it afloat. Everything else, all the other cyclical areas, not even close to being bullish. And we're significantly underperforming. Financials, industrials, materials, energy, all significantly underperforming the market during this period, which is not and still underperforming the market during this period. It's not the best sign for risk appetite. It's a reflection of just how bearish we actually were, even if those mega cap names masked the fact of how bearish we were. Now, I told you earlier when we do come off this low point, we want to see ourselves. We don't want to see utilities and real estate leading us, right? They've been leading us. You can see energy also leading us up here. They've been leading us up during this rally, and now during the pullback, you want to see these cyclical areas: technology, discretionary, communication services. You want to see them start to lead us up on the way back down to a new low point. So we're going to keep our eyes on those areas, or excuse me, as we do form a new low point, you want to see them lead the way back up off of it. I wouldn't be surprised to see these areas, these safe haven areas, still leading on the way back down. So it's not been a good sign for this bullish run that we've had to have these areas lead the way up. These really beaten up areas in the markets lead the way up. You want to see these areas down here, and they're starting. In fact, just looking at just today alone, it's one of the first days that we've had some good, strong outperformance in those areas. You can see technology, discretionary, communication services, all pretty much flirting with break even, whereas all these other areas, utilities, real estate, giving back a lot of gains, 4-3%. Industrials, financials also giving back, so and materials. So these are the areas that led the rally up. They're going to give back. They're going to have the most gains to give back on any kind of pullback, and looks like on day one we're starting to see that. So it would be good on any weakness to have this kind of pattern develop, and then we can have these areas continue to lead us on the way back up. Healthcare obviously is one of those areas that's been kind of matching and leading in both areas on the way down and now on a day like today. And that leads us to our trade idea of the day. So I want to take a look here at Amgen. And Amgen is one of the few stocks that's shown us an overbought cluster. An overbought cluster at the beginning of intermediate trends can be really bullish to kind of solidify the reversal in this case that we've seen. So nothing's up 100%, and we can have a pattern like this where we don't last very long to the upside before we pull back down. But it is a very good sign on this reversal where we have dark green shading and green line now that we kind of gave it a stamp of approval with that overbought cluster. Yes, the name suggests that we can roll over, and we might have some weakness in the very short term. But the fact that we were bullish enough to get that type of pattern early on the intermediate trend is a very, very good sign, especially with the market sentiment really down low and potentially rolling up, giving it some opportunity to run. And even over here, even with the weakness that you had, it was still higher low points on the pullbacks to the oversold clusters that led to this good, nice rally from basically from the low point of 170 all the way up to 240. So we're getting the opportunity for a move like that to occur again. If you take a look at its 3 green arrow chart, Amgen, you can see it's obviously got 3 green arrows. Its volume looks very much like the S&P 500. The difference between this chart and the S&P 500, any kind of weakness that it might have in the very short term, you've got the 8 and 17 already above the 30 and diverging with the strong MACD histogram here. The MACD getting up to high levels with the moving average following behind the stochastics in the entrenched there in the overbought zone where buyers are in control. You can see it getting above the value area, getting above the strong volume node to the upside. Again, there's some volume up here, so we're not looking for it to take off like a rocket, but it's establishing itself and getting through. And unlike the market 2, which is well below its Ichimoku cloud, Amgen is getting really close to getting through its Ichimoku cloud. Even if it kind of has some weakness here, you can see it doesn't have to be as high to get to the upside, and it's showing a moderately strong bullish trend now. So some much better signs all across the board. And another one here being, it's got it last week's bullish Hakunashi candle is really bullish too, and it closed above multiple weeks of highs. And then you're following up with a potential golden cross now on its estimate. We didn't have very long of a death cross, but a very good sign in that regard too. So Amgen's looking pretty bullish, and it's been an outperformer on the market as a whole. So it gives us an opportunity to say, okay, well, let's look at a bullish strategy, but one that will give us some time to work with. As I mentioned, we've already placed this trade in the Market Outlook Live at 3:30 Eastern Time. We're going to go out of the money here to a we'll go to this one here. Go out of the money to a 40 delta. And then we're going to position size around that full. So I'm doing a regular position size here, and I'm position sizing around the full maximum loss. That sets me up for a regular position. So that means it's going to be really hard for me to take the maximum loss on this, because you can see we'd have to go up another 40-50 bucks, or excuse me, go down 40-50 bucks for me to get down to really low levels on the ask price. So just going down 20-30 bucks will get me only about halfway to that point. So it's really hard to take max loss when you're position sizing around max loss, because if we do break down to the downside, then we'll just take that 50% loss there and get out of this trade early. But if we do take off to the upside with the rising delta and the rising implied volatility as we go from out of the money to deeper in the money, then we have an opportunity, even with just 1 standard deviation, to make a pretty strong run. We were looking at about a 3-to-1 reward to risk ratio by July, and we're going out to July to give us room for some ups and downs. And you can see here, but again, if we position it around maximum loss, just getting up here will give me a $3,000 reward roughly for $1,000 of risk, so a 3-to-1 reward to risk ratio with a 1 standard deviation move. And that's if I take the full maximum loss, which again is very unlikely. More likely to take about 50% of that, which is in this area here, down to 200. And again, to kind of show you what that would look like on the chart around 200, we'd have to fall all the way back down here to 200. Sorry, Amgen. We'd have to fall back down below the moving average. Basically below that breakout of 210, we nullify that breakout back below the moving average, and that would get us to where we've lost 50%. And even then, we still have some time to let it work out and see what would happen. That's the benefit of going further out of the money. It gives you that flexibility, and I can take the maximum loss knowing that the reward potential for just, again, a 1 standard deviation move from here is well worth the max risk. All right, well, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our forums, our community on our website at marketscholars.com. Part of what you get for free is access to this particular Market Outlook forum. And let's keep this conversation going. Post any new threads, reply to anybody else's threads with any questions or comments you have about what we talked about in the video. Technical analysis wise, from market relationship wise, anything that you want to keep talking about. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we created. Have a great rest of your Monday evening, everybody, and we'll see you all next time.